Good morning, everybody, and welcome to my SPX daily plan. And since we're here, I'm going to start here and then double back to the charts. And quick housekeeping announcement. I mentioned it yesterday. I'll mention it again today, and I'll put it out in social media on Twitter and Substack and wherever, Discord. I'm going to be away from the desk until Monday. Um, I'm going on a personal growth retreaty kind of hippie thing that I've been doing pretty much every year for the last 25 years with a lot of the same people. And so I won't be around. I may be able to get some version of a daily plan cobbled together Friday morning before I leave. I'm not sure exactly when we're leaving, but it'll be kind of early. It's about a 3 or 4 hour drive from here. So just an FYI. I'll do my best because I kind of take my obligation to people that listen to this broadcast, etc., kind of seriously. Okay. So somebody asked me how did I define a 30-point bounce yesterday. Um, the same way I'm going to do it today by looking at the gamma. So I'm going to start off with the gamma structure, and then and then kind of go backwards. And someone said thanks for the professionalism. It's not as much professionalism, although that may be part of it. It's just a sense of personal integrity and like wanting people to get whatever they can get. But anyway, let's not get carried away with this bullshit. Okay, so here we go. So what caught my eye, and this is not the usual view that I look at. This is customer positioning, not market maker, and we'll flip back to market maker in a second. And what drew my eye to that was this. When we look at the gamma heat map, blue is customer, short market maker, long support, quote unquote, edges, guide rails. We see all the way up in the sky at 69.80, above 7,000, and below 66, 60, 80, whatever, call it the 50-day moving average in 7,000 is sellers. That's sellers. And way up above in the sky, we have either the other side of these trades, like the 66, 50, 90, whatever, buyers. A lot of that's the 0 DTE gang and the 100Y gang, and some of it's right tail hedging up on top. But locally, we see red, market maker short gamma, which means customers are long. So I want to take a look and see where the customers are, quote unquote. And so customers, you, me, and the hedge funds and whoever, are long calls at 68.60, a little bit above where we closed yesterday, ladder all the way up to 6,900. So far that looks like a losing bet so far. Below 69.60, we have this cluster of customers shorts. That's market maker long, kind of an edge ceiling-ish structure, right near where we are, 60, 850, 45, whatever. And then below that, kind of where we are right now, we have customers long puts between 40 and 30, kind of a fly looking structure, long 40, short 35, customer long 30. That might be a good structure to copy. Do a fly just looking just like that. 40, 40, either a 5 wide or a 10 wide or something like that. That might be a decent play. And then below 68.30, Not much happening. I saw some volume down here at 6,800 pre-market, and it seems like there were sellers. Now on this old computer, the things kind of get sticky, so I'm loath to change things. But let me see. I also saw some action at 75. So let's just go 65. We don't need to see all the way up in the stratosphere because that's not really going to be much relevance to today. So let's just say 35. Even that's not much relevance, but let's just kind of see. Okay, so with markers on, it just nets everything out. And we see a little bit of addition to the short, customer short in this range, 6,800, 6,810, 6,790, 6,800, where is it? That's over here. A little bit of addition to that. A couple more were added here. So this is customer side of the table, I believe I have turned on still yet. So let's look at market maker, what we typically look at. And okay, so when we look at this, we just think, or I just think to the right is quote unquote resistance or support, understanding that we mean revert drift toward a level that's either above us or below us, the same thing. And so we see a pretty heavy but mixed cluster here between 40-ish, 45-ish, whatever, kind of where we closed, all the way down to 6,800. But we see a fishbone pattern, long, short, and then depending if volatility expands or contracts, these lines get fuzzy and they become zones. Now, I saw some people write gamma is positive, whatever, however they say it. And if you've been listening to me for a while, you know it's a pet peeve of mine to say gamma is. We're in positive or negative because we're not in anything. Locally, gamma is negative. Market makers are going to hedge in the direction of the move, amplifying direction. Broadly, it's positive, creating sort of a supportive bulwark behind us. That's the best way I can describe it. No, okay, he's already there. Okay. So that's that. Vol Trader, who was on yesterday, will be on today. I sent him the link and he prepared something. We were chatting before the market and he kind of sees weakness with his method looking at skew, and he'll explain that. And maybe one day, not maybe, definitely one day, I'll do a webinar with him where he can explain the method in detail and define skew and how one looks for that and all that and why it matters. But in the meantime, so far he's late to the party, but he'll show up. He showed up yesterday. At least I think he will. Anyway, that said, let's find the trading view chart. We're kind of going in the inverse order from the order I typically go. Okay, so here we are. Looks like we have a down goes Fraser bar. Fed Daily was talking at whatever 8 o'clock, and apparently whatever she said, I believe it's a she, made the market unhappy. I'm pretty sure she's kind of been vocally kind of hawkish, and so whatever. So the algos didn't like it. So here we are, right at the bottom of the chop zone, right at where those customers' long puts are. Are they going to sell them? Are they going to monetize them and roll down? Are they going to hold them? I mean, the odds of that going in the money and staying in the money and being held till the end of the day, I don't really know. So I put in a few different expected moves today. I kind of wanted to get a feel. And so here was the bottom of the chop zone, which I just defined as where those 60-30 long puts are. I mean, technically, We could say that 35 was the bottom of the chop zone, and now we're kind of into the lower zone, potato, potato. And the bottom of the expected move when I checked this morning at 6 a.m. was around 68.15. The bottom of the expected move when I checked Thursday night, and you can have some discussion if the closing EM is more valid, quote unquote, or the live straddle price is more valid, and the answer is it's both. It's not an either or. And when I looked at Friday's expected move at 6 a.m., it put us roughly at 6,800-ish, right around here. So if we have a down day and we exceed the expected move, and for the last few days, even though we've had these kind of wide intraday swings and gamma has been negative, we've ended up closing up 0.2 one day, up 0.1 the other day, after like these big bounce, these big drops, or relatively big drops, and then retracements. Is that going to be the playbook today? And are we going to end up back in the 68.50 range? Hard to say still. Now, yesterday, just for example, as we were busy, going down, testing the lower range of the chop zone that I defined yesterday, which is kind of where we are again today. Actually, I defined 35 as the lower range. We kind of undercut it by a couple pennies. As we were down here, I'll call them algos, whoever they are, came in buying like 1.5 thousand, 68, 60, 90 call debit spreads on the cheap. And what do you know? We kind of went up towards there. And of course, I'm sure they got dumped and there was, trading in there. I'm saying that to say this. And algos came in, they sold pretty close, like 68.15, the 5 wide and 10 wide hedge funds that we see every day, about 4,000 or 5,000 of them. They sold them right over here yesterday. And that gave me confidence that that was a floor. And so I had sold puts down below 6,800, and I just added to them as we were going down, and bought some call flies, whatever. And I also bought put flies when we opened because we saw it in the structure, and I did it live on TV over here. You saw it. I didn't do anything that you didn't see, and I monetized them for profit. For educational purposes, I'm doing it to show you how to fish, not to fish for you. So anyway, and so here we are at the bottom of the chop zone, and we'll see what happens. VIX is kind of back at 18, and that's been the other pattern. The VIX broadly 17 to 18, and we looked at the VIX positioning. Now let me go there for a second. Hopefully this doesn't crap out on me and I don't lose this. So emblazon this picture in your brain in case this old ass computer doesn't work good. Let's take a look at VIX position, and I want to show you something. And McElliott in a note talked about some whatever it was, 150 million, whatever. So some big VIX trades that came in the other day. Customers, I don't want to see net. I want to be able to see, okay, no markets, I'll be able to see. This is customer side of the table. So let's just get rid of the puts for a second. So customers are long calls between what? Between 16 and 18, that's kind of where you want to stall. Same dynamics. 16 to 18 is kind of a glide path. Over 18, there's some shorts. People buy spreads. I do too. Flies and stuff like that. I'm not buying or selling naked VIX. I always do it in ratio spreads or butterfly spreads or whatever. Um, but then if over 18, then you have to grind through to 20. Then if over 20, then we're back in the range we were before during like the debacle where we went to 22-ish or whatever it was. So 18 is kind of the top of the range. Liquidity is thin pre-market. So this might be a little bit of pre-market hedging of this move. And maybe it's done, maybe it's not. I'm just thinking out loud here. Okay, that worked well. So let's get back to market makers. Let's get back to SPX. And now we're back on the customer side, the view I showed before. And so we have, what side am I on? That's customer side. So we have customers long puts. Okay, so we have customer straddle action here at 6,800 now. So that's, I have I have a range. Okay. Let's get to 0 DTE. Okay, that makes more sense. We have customers short down here, so that should be supportive, we hope, we think. Okay, one last thing, let's look at depth view just for another way to look at this, and then I'll turn the mic over. And so this is just the same view where we can see numbers, number of contracts instead of bars, which reflect the number of contracts. The other view I like for the shape, and this gives me a better view of absolute value. And so what do we see here? Well, I'll tell you what I see here. I see between 65 down to 30 or 35, kind of smallish numbers, almost 1,000 matters, almost 1,000 here matters. 1,300 customer long calls matter. That's over here at 6870. Customers long calls at 60 matters to a degree. Locally, this is what matters most, the puts, and we're here. And then below here, we have a couple thousand puts sold at 6,800, 6,810, which should mark the bottom of the range. It's beyond the expected move somewhat. We have some longs here, which are, I was going to say clearly, although I don't know with 100% certainty, that somebody sold 6,800, 6,790, but that certainly makes the most sense. And then between that is a nothing burger. And that's what's going on. And so just in case you guys aren't as fluid in this, so that's broadly supportive over here. Market makers buy as we go down toward a level, but then as we recede to away from it, they sell, sucking us back to that level. And on top, we don't really have anything like that. On top, we pretty much have attractant. If we go up, then we just keep going up. And the thing about negative gamma, where customers are long, market makers are short, is we accelerate into the move, but then once we stall, the buying they had to do on the acceleration becomes selling. And so that's what gives us this kind of choppy, whippy price action. Okay, let me get the chart back up. Let me see. Bottom of the shop, where do we bounce? Doc, it's amazing. No, it's not amazing. It's just the data. It's just there. Just the data. It takes a minute to get used to looking at the data and seeing it this way. I've been looking at this Gex nonsense pretty much as intently as I could since 2005. Since 2020 when I started getting availability to it. 2019 I had a little bit. There wasn't much out there yet, and so yeah. Okay, young man, you're up, and you're muted.
Good morning, everybody. Let's look at it today. What are we at right now? 68.55 on the ES. First thing I'm looking to see is if we can come to 68.40. If we can hold 68.40, I think that would be a buying opportunity back to 68.60 and then potentially even 68.70. But I'd like to see that 68.40 first. If we can break above 68.75, and I mean a good break, I would like to see a decent move to the upside, targeting what is that? Another 20 points from 68.75. Downside gets a little more interesting to me. If we can hold below 68.60, then I could also potentially target down to 68.40. So kind of a little bit of ping pong action that I'm prepared for today. Again, below 68.60, I'm targeting 840. And from there, I might get some upside potential. If we can't hold 68.40, I'll be looking at 68.20 next.
Bro, you have every single line on my chart there.
Seems like we should be working together, Doc.
That seems like it. Seems like it. And that's what I like. I love it when you see the confluence of different methods, giving extra, for me, confidence in taking those levels.
Yeah. Yeah, same with me, especially when they align with your string nicely. I think it just lets me be in the trade with a little bit more peace and tranquility on it, which I end up executing better because of it. So, I mean, that's kind of what I'm seeing today. In my opinion, if we see a good downward movement at open, that paints a good picture for upside today. But we'll just kind of have to wait and see. Above that, 68.75, and I think we can target yesterday's pre-market high at 6,900.
Which is basically the top of the job zone. Which is basically, yes. I mean, everything lines up. Everything just kind of lines up. Where, even though it might look sloppy, when you look at it at first blush, when you look at some of those basic look left horizontal support and resistance lines, and you look at where the option structure lines up with it, it's kind of like, it's actually a pretty, I don't want to disrespect the market, but kind of a pretty easy day. It's pretty clear what's going on.
Yeah. I do think the order in which things happen can change the way it actually plays out.
True.
Which is why I'd like to see downside first. Me personally, I'm a bull in this kind of end of year term, and so I'm playing upside hard when I see it. And for me to feel comfortable with upside, I really like to see a push down first. So that's kind of my theory going into today.
Okay, we have some comments here. I missed it. Sellers own below 68.40. I'm going to ask them what So got some comments here from G Money.
I'm reading a message here from Phoenix. It says,
Let's see. Let's get G
"Pretty
Money's
cool that we were
comments.
contained overnight in yesterday's SPX range." I mean, the way I see it is just kind of choppy market leads to big expansion moves. Whether the move is to the upside or downside, that's
I'm not sure.
harder to kind of clearly
Below it.
predict. I'd like to see upside just from what kind of my macro stance on it. But yes, short answer, yes. Consolidation in the same range could lead to a big move. Whether that comes today or tomorrow, I'm not sure. You could stay in the range. I mean, the levels I gave y'all today range anyway, so can be.
And I know some other people who only trade market structure. I'm friends with them regardless. That's a joke. Yeah, it doesn't really matter how you get to where you're going. I used to trade with this former hedge fund guy. Long story. His backstory is a long story. Short version of it was his hedge fund firm blew up in 9/11, along with a lot of his employees, whatever, the standard late to the office story. And he stopped trading for a long time, then started trading again about 5 years ago. And so he used to say that when he would look to hire traders and stuff for his hedge fund, he didn't want people that traded the same way that he did because he could do that himself. He wanted people that were successful. He didn't care if they did tarot cards or astrology. As long as it's successful, that's great. It adds something, doesn't detract. So that was always an interesting lesson that when I heard him say that, that made a lot of sense to me.
Yeah, what's nice about trading is it's very obvious if it's working for you or not.
Right,
You're either
right.
making
Your
money or
P&L
you're
doesn't
not.
lie,
So,
right?
yeah.
And so I'm not going to denigrate any method or glorify it. I know what works for me. Some different things speak to different people for whatever reason. For whatever reason. And so anyway, bottom of the EM here. It's having trouble holding, but this is pre-market, so it's kind of hard to overinterpret that, if you know what I mean. Let's see. I don't want to look at the VIX, VVIX. Trying to find 6 panel. Let's take a look at what's going on over here. Come on, you can do it. Okay, so yeah, as I mentioned, VIX back at that crucial 18. Now, we had been having like the VIX versus the VIX 9-day, like last week, practically the same, almost backwardated. If you wanted to say a 9-day, 30-day backwardation, which is not an official thing, but it's a thing for me. And we're not really haven't been seeing that much lately. So whatever short term, whatever bearishness we'll call it, whatever, has now translated into long term or to standard term, for lack of a better word. VVIX, the volatility of volatility, using the same calculation method that's used to calculate the VIX, only on VIX options rather than on SPX options, is over 100, critical, kind of sort of easy back of the envelope, bullish, bearish sort of number. Of course, it's always relative. VIX is always relative. I'm of the mind that VIX is math, and so support and resistance and all that are kind of meaningless. It's what people are paying right now and what they paid before for protection 2 months ago has little relevance. What has more relevance is realized volatility versus applied volatility and some of the mathy stuff. But if you want to write a newsletter and don't really feel like getting into the weeds on it, it's nice. You can just say, oh, VIX support or resistance here. And it sounds like you know what you're talking about. I'm not judging, I'm just saying. Okay, here's the move index, which is finally picking up the volatility of volatility. Volatility of the bonds. It had been dead for a while, as you can see. And now that's starting to pick up a little bit. Let's see what else is interesting. In this panel, I usually reserve for other stuff. And so we could take a look at what else might we want to see. The VIX EQ. Equal weighted, this is the volatility of the constituents. And again, not shocking. After earnings, we went down. After all the, mag earnings, 491, I think, last I read. I could be wrong by a couple numbers. Constituents of the S&P 500 reported, so a lot of that earning vol is out. Oh, there's one company that hasn't reported yet. You guys might have heard of it. They make chips. It's called NVIDIA. And so that's sort of the big turn, the big question mark here. And so this spills over to the dispersion trade, which broadly speaking is institutions and people fancier than me selling index vol and buying constituent vol. What does that mean? Sell, let's just say, SPX straddles or strangles or whatever it is, and buy straddles and strangles in Microsoft and NVIDIA or whatever, with whatever kind of mathy proportions that you're basically getting free volatility. I can't do that. That's it's kind of fancy stuff. That's the basic, simple, poor man's explanation of that. And so this is coming down, so that's kind of really good. Do I have the equity only put call ratio on here? So here's the dispersion trade. Now notice, here's the constituents, and then the dispersion index basically mirrors that. Dispersion index basically mirrors that. And then the correlation index is sort of the inverse of that. What the correlation index basically says, when stocks go down, they all go down together. Whoop, they're all correlated. Everybody gets down. Baby, throw out the baby with the bathwater. And when it's real low, there's kind of rotation. When it gets this low, it's too much. Everybody's on one side of the boat, on the other side of the boat. And here is kind of normal rotation correlation. Kind of normal rotation correlation. So there's nothing crazy going on in the VIX space, but it's not exactly pretty. And late to the party, but here we have my buddy Vol Trader. And without further ado, I'm going to turn the mic over and pull up the chart so that if I could find the chart that I was on, I think it's this one. Yeah. Pull up the chart and let me put you on the stage. Whoops, I had you there. Okay. Let me put you on the stage. Let me get this guy off.
Could you please share that file that I sent you?
Yes. I even prepared to do it. Let me see if I can figure out how I did it. Here it is. Here's the file. Go ahead. Explain to us what this means, because this is fancy stuff.
Well, first of all, it's basically like your stuff, but I have just a bit of a different angle. I'm looking for the 6820 6,800 to tag that at least once today, or as close as possible. That's what you and I were divided on this morning. But other than that, this pretty much matches your analysis. Again, I'm very influenced by the dynamics of how the market making machines, which IV they plug for every strike. So I'm very influenced by that. We talked about this yesterday, and what I'm seeing basically is they need that tag. I don't know exactly why, but they need it. And I still suspect that we bounce off those 6820, 6800. We bounce off those into tomorrow. Maybe obviously could bounce today, but I think there's some information into tomorrow. What I'm seeing for the last 48 hours is like a massive pressure on the call side of the wing, meaning 6,900 and over.
Right.
And I'm seeing that they're constantly bidding there. So this was throughout the whole week, other than today, right? This is why today I'm a bit more leaning bearish than your average expected move. But other than today, there's a constant bid there into November 14, tomorrow, buying those out the money calls.
Yep.
And lifting that wing a bit higher. Today it's less obvious, but it was there, and it was not just a quote. There were actually a lot of trades there. So what I'm thinking is either they're just selling every single premium available between 6,850 and 6,900 beginning Monday this week. So they're just shorting everything consistently, and they're buying their protection hedge from 6,900 and above, right? Which might make sense, especially if we go down today. But because that was pretty consistent, I still think there's a chance we basically explode to the upside any day, meaning I might be wrong about tomorrow, but I think next week we could easily go to let me tell you, we could easily go all the way back to the highs, so and over. So I'm talking about 6,700 7,000 on the ES, which is around 6,980 on the SPX. I think that move is still in play into either tomorrow or next week. Probably some information that we don't know, and we'll probably hear about it later on as usual. But for today, they need to balance out at 6,820, 6,800 on the SPX to basically close out or max out their positions here, which are bearish mostly, and then I think we'll get a strong bounce. So this is how I see the things. This was basically what the skew said the whole week. So I'm holding this position from 6890 ES, which is around 6870 SPX, and I'm planning to cover it once we tag 6820 or under on the SPX. I'm planning to cover that and start building that upside into tomorrow maybe, or into next Friday, just like the skew shows basically. Now this is where maybe you come in, because obviously going long is, nobody needs help with that, but I guess you have all those fancy multi-leg iron condors, broken wing butterflies, whatever, and I think it would be awesome.
Why,
yeah,
why,
and
why,
I think it
why
would
use
be
one option when you can use six?
well. I'm not looking at it. I'm not looking at it from. I'm not criticizing the complexity. I'm actually thinking it's the right way to try and set up the cheapest and widest available multi-leg strategy, and I'm willing to do it into next week. That would cover, say, 60, 6880, 6900, and all the way to 6950 on the SPX. I
And
think that would be.
that's where just the way we structure it differs, not a right or wrong, just a comfort. You tend to do a lot more calendars than I do, and they work. I'm not saying they don't work. I'm just not as
No, I'm
fluent
doing,
in the
first and
calendar.
foremost, I do long, short, aggressive, directional. And yes, I do use covered calls or covered puts against my future positions, right? But that is because I like to maximize not only direction, but also time. We are always, as humans, we have a tendency to believe things should happen at a certain time. That has no meaning in the market. The time, the human concept of time does not exist in the market, in terms of direction and when the price will be here or there, right? I mean, we tend to believe it's there because of the options, and we tend to time things towards expiration. But in reality, the market is its own organism, and it has a different dimension of time. This is my philosophy. So what I'm trying to say is that in this case, because now it looks a bit weird to, somebody comes in and says, yeah, the market's going to be 69.50 next week, right? That's what I'm saying. I think that should be actually positioned not via a directional bet like buying the ES, for example, but rather something that makes sense, that can sustain time, is not too expensive, has a 1 to 10 ratio in terms of cost to profitability, and is wide enough to capture that move. And hopefully the market won't blast through it, right? So those are things you do. I can do, but it would take me like too long.
So could you guys imagine being in a trading room with me and him on the mic all day long talking about this crap while we're trading? Because that's what it was like for a
I
while.
wish. I wish.
Back in the
I
day,
wish.
remember?
Well, I wish we would do it.
Well,
this
I'm going to
this could
get
be
you
a
to join
trading
in.
room. Yeah, this could be a
I'm
trading
going to get
room.
you to join in on the stream with me during the day. We'll kind of talk about that and set that up, and also maybe do some webinars together, and we'll kind of like talk about that a little bit. Um, as far as the path trader version, I don't think we differ as much as like the discussion in the morning. I agree that the primary path going into the day was this, maybe kind of stop somewhere here and not get to here, although we could overshoot. And then I believe from here, the path goes
Back.
back
Yeah, we
toward
just printed.
here,
We
and
just printed.
we
We
don't
just
get
printed SPX 6818 or 6819. So it's pretty close to my
yeah, yeah, pretty
prediction.
close to the bottom. Yeah, uh-huh.
But it could be, it could easily overshoot into 6800.
Sure,
But then
yeah,
I agree that that's where we now merge, and we assume that from those levels the market will recover back to whatever 6850 or something. That's the assumption, right?
right. Now, in my old age, I'm more and more of a straddle guy, just looking at straddle pricing and various time frames and stuff. And as it turns out, great coincidence, last week on Friday, the Friday to Friday straddle. Now, this was before the positive announcement Sunday that had the market pump and all that, the shutdown ending. The top of the straddle was 6850 ish, give or take, a little bit. And so ending up around 6850, kind of at the top of the straddle, nicking the top of the straddle for Friday, is not so crazy. And if we look at the straddle, when I looked this morning at the straddle price today for Friday, it's more or less 50 points. So it's more or less 6,800 bottom, 6,900 top ish for Friday. And where we end up in there, potato, potato. But
Well, for Friday, for tomorrow, you mean 100
yeah,
points,
for
800,
tomorrow, yeah.
900?
Yeah, for
Yeah, it
tomorrow.
seems, but it will be, I mean, this is if you sell the 6850 now, right? So that will make you very long if you were to do that straddle. To capture that range, you need to sell the 6850, which would have a very rich put and a very thin call, and then you capture those. Then you capture that straddle, but you open this with a very strong, with a very elevated delta because of the short put. If you go at the money, you don't get 6,800, 6,900. You get
If you get the
6,850
money, you can't
probably.
get it, right?
Yeah. So now it's very easy on X. We hear a lot of people, they say, yeah, and you hedge this and you hedge that, convexity, all that shit. The truth of the matter is, if we would do this, right? Let's say we would sell the 6850 straddle for tomorrow. So we get a bunch of positive delta. And now we want to hedge, we want to neutralize a bit of that at the open. So meaning we set up the strategy and we buy some out the money puts or sell a couple of micro futures against that to pretty much neutralize all or part of the delta. Now, the market is super sophisticated. If you would do that, and we're not market makers, right? We're not continuously doing that. We just do it on a setup. We would not make money. We would basically, the market would bounce. We would need to get rid of the hedging that we did at the open of the strategy. And that's basically taking the stop loss on short, right? That's how we neutralize the deltas in the first place. We would start to bounce around with that. No money would be left. What people miss or don't understand is that hedging in theory is very nice. In reality, very complicated. And even if you do it, it's always a very simple math. The total amount of the optimal, 100% optimal Citadel style hedging, the total amount of hedging required equals to the premium that you sold.
Right.
So if you're continuously hedging and you're Citadel, that works. But if you're not, and you do it, and then you ask yourself, when do I get rid of the hedge that I just bought at the open of the strategy, right? The market goes up, 1 point, 10 points, 7 points, if my delta goes this, that. You start trying to figure that out. By the time you're done, your losses on those hedging in and out will be equal to the premium that you got in the first place on the straddle.
Right. At the end of the day, you break even if you're lucky, if you're good.
Yeah. So you need to get this right, and the only way to really manage these, if the market moves against you or challenges the edges of the payoff, is just by you need to really know your direction and decide. For example, today, if the market goes back above 68.35, 68.40, I would then go long, and that would neutralize the call leg of the straddle that we saw that at the money right now. That's the only way to do it, right? You basically need to edge at the last possible point, and that is if you know exactly where to go long. So just by looking at your chart, let's say we would just do it by technical analysis. So that level 6850, where you have that big, where it says pivot, obviously if that is taken out, the market will go up, right? So if we were to sell the straddle here, that would be where I would hedge. I would just buy the future against the short call of the straddle, and that's it. But other than that, I won't hedge to the upside. And if it goes down, we need to decide where is the last point that we need to hedge that put of the straddle. That's pretty much it. It's not very difficult because if you do day trading, you do it anyways, right? Just not against a position. So, but still, it needs to be well planned and executed perfectly with no questions.
Okay, I was gonna show.
What is this fancy screen that you're showing us? What is this? You have every single tool available on the globe.
Yeah, I do.
That's fucking unbelievable.
I do. This is just Hasty Works, but I get as many tools as I can. And see, I'm not fancy like you. I don't know how to create the stuff like you create the stuff yourself. So I just
No,
kind of
there's
like,
no there's no difference, my friend. There's no difference. It's no, I disagree. We eventually overlap the same levels, the same dynamics.
no, I
So
mean, I'm not fancy enough to be able to create this little thing that you create where you get all those numbers and stuff. I don't know how to do that.
yeah, that's just the visual portion of the text. Yeah, it's not something
Anyway,
fancy.
so yesterday I put on some trades at the end of the day. They were nice and green before, but now I'm down $61. Not a big deal. Um, and what this was, I was kind of experimenting. So I bought basically a strangle, a 5 wide strangle on each side. And
Okay.
so the put strangle is going to be fine, obviously. I'm probably going to monetize that. And I wrapped the butterfly around it. So that's going to be playing around a little bit. And the call strangle right now, obviously, is not doing much, but I'm not worried about, I mean, it was an experiment anyway. Um, and so, so we have this whole mess over here. Here's a coral strangle wrapped in a fly. Here's the stuff I sold on top, which is worthless. I'm gonna close that crap out. Here's the put strangle wrapped in a fly. I saw the 30. Had I close it down a pointer, 5 points, it would have been nicer. This will do
So
well.
so you don't have you
Back
don't
up.
really have it. You don't have really any exposure other than that broken wing at the bottom. Other than
And
that,
then I have
this
this
will.
down here at 67.90, which is a little dicey, but I think it'll be fine,
Yeah, it's
Um,
only it's only. Oh, you have more legs. Can you
and then I
show
have
the
this
whole
crap
thing?
all the way down here, which actually, what would I sell right now in the church of what's happening now? I mean, shit. Pardon my French, but I don't know,
I
67,
think I think
70.
actually you're gonna do well if you don't touch anything.
Yeah, that's what I'm going to do. I just have like my little preset exits. I'm just going to leave this alone. I like what I have here, and that's what I mean when I was saying before. I build relatively complex structures
Yeah,
that kind of cover lots of eventualities, and I trade around them within them. Whatever.
yeah, yeah. That's why I said that you can. I mean, you take my crazy idea about the 6950 into next Friday. I'm sure you can design the best, and I can also imagine maybe part of the path, and that's on me, but you can design the best setup that can just be there, and you don't have to manage it too much and just let the market do what it does.
All right.
Regarding your position that we just saw,
Wait,
I think that
I do
as
have
long
a
as
tendency to overmanage sometimes. I do have a tendency to overmanage sometimes. I think because I just like being active, and sometimes I manage. Oh, great, recurring lead.
Sounds like you guys do this for a living.
oh yeah, what do you? I don't do anything else other than
I know, I'm
trading.
kidding. I'm kidding.
The
I tend to
I mean
manage.
regarding your put side of things, as long as the 6800 SPX holds, and we both agree on that, it seems it will hold regardless of any overshoot. So as long as that holds, those multi-leg put things you have are gonna make nice money, like into the end of the day, right?
Uh-huh.
The only thing is that you might see that P&L inflate 4 hours from now, 3 hours from now, and then the market will bounce back up.
Right.
Right?
Well, what I tend to do is I put it on. It's put on like that. But I tend to take off pieces as we follow a path.
Yeah. This is the net. This is market maker positions, or this is customer positions?
I think
What
this
we're
is
seeing.
customer.
Can you
Let me-
can you show the market maker thing?
Yeah. Let me get. I think this is customer. Yes, it's customer. Let's go to market maker. Now let's go net. Now let's get rid of puts and calls. Let's look at what really matters, where they how they net out. And so it's frog in a blender. It's fishbone.
Yeah, I mean, it's always a fishbone. I mean, if you would stretch this visually, it would look less like a fishbone. But what we need to see is that bottom portion where those two, what strike are
6810
those?
and 6800.
Yeah, so they are long there, and then immediately short just beneath that. So that's the support I'm looking for. That's the support I'm looking for, right? Now they sell into that 6800 because they're long the calls, so they're losing the deltas, and the market was up, so they already hedged the positive deltas from those, right? So now the market is going up. So they were long, they sold against that. Now they're going down. They have access of short positions. They need to buy that. So they are actually going to, because of several long call sides into the 6800, all that cluster on the call side, right? They basically they basically need to dampen. They're going to buy into 6800, right?
And
Because they already neutralized the market.
short calls here and here. And so now following the same line of reasoning, whatever hedges that they had on for the stuff at 6860 and higher, that stuff has been sold. So then as the path goes up, and as if the path goes up and these get to be a 15, 20 delta, whatever, suddenly we get the accelerated buying. That's why I'm kind of looking for a V-ish kind of bounce if we can just stall down there and stay there,
Yeah, we need to see that strong bounce of the 6800 SPX. We need to see it to know we're on the right page. Otherwise, that will slip down, right? But
now,
I think
other thesis is that if we look in the VIX space, and I don't know if you were on before, and I looked at it, I'll do it real fast. If we look in the VIX space, right?
Yeah.
Hold on.
The market starts in a minute, by the way.
In a minute? Oh shit. Okay. Well then, I'm gonna keep everybody in suspense. If we look in the VIX space, customer side, and look at the calls real quick. Got 1 minute to do this. We see customers are long calls between 16 and 20 with this little stall right here, right above 18. And in the pre-market with VIX going up, with the futures thin, this had to be hedged relatively aggressively. And I think we might see VIX revert earlier than we've seen it the last few days, where we've seen that move from 17 to 18 happen relatively as the market opens. I think a lot of that move has happened. Okay, goodbye, everybody.
Bye-bye.